All right, 30 minutes away from the last trading day of the week. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Sonali Basak. Katie Greifeld is off today, and Bloomberg Open Interest starts right now.
All right, we are focused on some big stories today. FedEx cutting its outlook and disappointing with its quarterly profit. The stock is absolutely decimated in the pre-market. Plus a C-suite shakeup. Nike rallies as veteran Elliott Hill comes out of retirement to step in as CEO. And let's take a look at where markets are trading right now in terms of futures. We do have red arrows here. They're slight, 0.1% on S&P and NASDAQ futures, with the U.S. 10-year yield also not moving much. Is that fair to say? Not much. It's less than 2 basis points. But wow, yesterday was an amazing day, and we did hit an all-time high with a 1.7% rally into the close on the S&P 500. So safe to say we're coming off a lot of enthusiasm for equity. Sonali, what are you watching?
To see the market start taking a breather here. Let's watch some stocks before the market opens here. FedEx, as Matt has been talking about, lower after warning that its business will slow in the coming year, which is a potential warning sign about the direction of the U.S. economy. We're seeing FedEx down 12.7% pre-market. Also watching home builder Lennar, disappointing as prospective homebuyers have still been hesitant to make offers even as mortgage rates continue to drop. You have a 3.6 decline pre-market in Lennar. Nike, keeping an eye on that, of course, too. Big story of the day, 8.5% higher pre-market. Nike is replacing CEO John Donohue with its former executive Elliott Hill. We're going to talk more about that this hour, Matt.
Yeah, absolutely. And wow, Microsoft is going to reopen a reactor at 3 Mile Island to power what it expects in terms of its AI demand. So that's an awesome story as well that we'll touch on. I think the FedEx story was absolutely fascinating yesterday, at least for me, right? Being kind of an old market watcher, we think of FedEx and UPS as these bellwethers. So when they miss and when the stock gets taken down so much, Sonali, it really makes me question the U.S. economy. On a day when we had a huge rally, but a 50 basis point cut. So if the Fed needs to cut by that much, will they need to do it again? And, markets are pricing in even more cuts than the Fed showed on the dot plot.
And clearly, the markets have not quite made up their mind about what that 50 basis point means, the direction of the economy ahead. I want to point out that note from Bank of America's Michael Hartnett this morning, who says we're now reaching bubble territory, with the markets pricing in another 200 or more basis points worth of rate cuts through the end of next year, and 18% earnings growth in the S&P 500. He says It doesn't get better than that. He says to start hedging. He's not the only one. We're going to talk more about this now at the desk with Dawson. She is Chief Investment Officer at Newedge Wealth. I want to go back to something Matt was talking about here, about FedEx, because now you are seeing FedEx really taking a hit, perhaps dragging even more the market lower pre-market now. How much can you extrapolate that story?
I think it is tempting to extrapolate because FedEx has often been lauded as a great economic indicator. But it's important to remember that there's been a lot of idiosyncratic issues with FedEx on execution, as well as the fact that there's still a big overhang from the supply chain bullwhip effect that's still affecting their business. It's interesting. If you look back over the last 20 years, there used to be a very tight relationship between the Cass Freight Index and the S&P 500. As you moved more stuff around the economy, you saw stocks go up. Since 2022, that's completely broken down. Stocks have soared, and you've seen that Cass Freight, that trucking index, completely plunge, which just suggests that this stock market is more of a reflection of intangibles and AI and tech versus the real economy.
But at what point does the real economy start to impact here the stock market? Because if you're saying supply chain bullwhip is part of the problem here, then wouldn't that be something that you have to worry about in terms of future inflation?
I think it is a very important point because we've also seen what's the one pocket of weakness in economic data, manufacturing data, and you've still seen this impact of price pressure within even a weak PMI, which just suggests that companies are still seeing price input cost increases. However, what they're seeing is fading pricing power, and that means that they're not able to pass on higher input costs onto their customers, which is one of the reasons, as Michael Hartnett was talking about 18% earnings growth next year, that relies on a lot of margin pressure. If you're seeing higher input costs as well as fading pricing power, it might be hard to reach those margins.
You know, I think the Hartnett note was interesting because I have this picture of investors who haven't caught up yet, just buying in at any price, right? And that makes the floor a lot further down. I mean, if we start to get a little bit of a downturn, those losses are right there for them, so they have to sell. Do we get another August 5th?
We are still in a very seasonal stretch of higher volatility, and volatility even kicks higher technically within October. So we wouldn't be surprised to see that volatility. One of the interesting dichotomies here is that if you look at individual equity positioning, it's still only 1% off of its 20-year high, which just means that individual investors are fully invested. But look at the Deutsche Bank Consolidated Positioning Report. It's down to the 54th percentile, which means that institutions have pulled back. So maybe that kind of push-pull between different cohorts of ownership can help lift the market if you need to see institutions pulled back in. But to your point, individual investors, they are fully invested.
Yesterday we spoke with Steve Eisman, who said, come on, it's all about the economy. If the economy is good, stocks are going to go up. If we're headed to a recession, they're going to go down. What do you think about the economy, especially in light of the Fed's double rate cut yesterday?
It's such a good reminder that good news is good news and bad news is bad news. Maybe over very short periods of time that gets flipped and inverted. But at the end of the day, as long as you're in an environment where you are seeing forecasts for GDP growth, forecasts for earnings growth continue to rise, that is a good environment for stocks, even if it means a tighter Fed than what the bond market is expecting, for example. So one of the things we're watching really closely is that earnings line, which is that earnings expectations for 25 are very high. And for the first time in a year, you're starting to see 25 estimates level off and tick just slightly lower. It's not enough to say earnings recession. It's just to say that expectations are high. Can we really achieve that? And the bull case would be because of Fed cuts, we could.
I will point out, Sonali, that I was talking with Gina Martin Adams yesterday, and she said a lot of that earnings revision concern is down to energy stocks alone. That sector,
and
obviously.
We're watching it very, very closely.
Yeah, of course, because they've had lower prices.
The other thing I want to ask about regarding this Hartnett note in particular is how he says to hedge. He says through bonds and gold. We talked to Amy Wu Silverman earlier this week over at RBC. She talked about the options market being a very good place to find some cover. Bonds in particular, I think this is where my questions lie, because if you saw a 50 basis point rate cut and the next day you saw the 10-year just plummet, then why would bonds be a good hedge?
Well, it's such a good reminder that the bond market has priced in almost the full extent of the Fed easing to come, and that if you don't get that easing, the bond market could be disappointed. Also, remember that you have economic surprises that are turning higher. That has often been correlated with higher 10-year Treasury yields in the short term. Don't forget that we have fiscal stimulus on both sides that are being contemplated within the election as well, which just suggests to us is that bond yields got very oversold. They could bounce, but if they bounce, that's an opportunity for us to continue to move out of cash and extend duration in order to get that diversification that bonds will provide, because we do think this is different than 22. 22 was a year of rising inflation that was really bad for fixed income, which just meant that they did not diversify. If we have a recession, we think bonds get their diversification mojo back.
We have to redefine plummet, I think, because I'm all for sensationalism.
They took a
but if they're up
serious
3 basis points, I don't think that's really plummeting.
At first, it was 7.
7 whole basis points?
Okay.
Yeah.
So where do you hedge then?
We've been using the options market to hedge where investors are feeling a little bit shakier. What we're able to do is structure a hedge where you're still able to get upside in this market and really targeting that upside range that some are talking about, that 6,100. If we were to get there, you are trading at a valuation that we haven't seen since the peaks in 2020, late 20, early 2021, which means that that seems like a very fulsome place to hedge up to the upside. And then that allows us to be able to hedge downside 15% or so in the event we get a period of higher volatility.
You know, speaking of hedging, where do you look for safety in the stock market as well? Because if FedEx had a number that sent it far lower, not plummet, maybe, but far lower. You also have the same
FedEx
thing.
Definitely is plummeting today.
Okay.
I think if you're down 14% in a stock, that's a plummet. Yeah.
UPS also plummeted when it reported earlier this summer. So at what point do you say avoid the real economy sectors in the stock market? Is there somewhere else that is defensive to be hiding?
Well, we would be cautious, at least in the very short term, of chasing these super defensives, your utilities and your staples. They've gotten very overbought, and you've seen excessive inflows into those sectors, which just suggests that you could see a breather. Of course, if you do see a pullback to trend and you still have fears about economic growth, then maybe that's an opportunity to buy. The utilities aren't necessarily expensive either versus the market, which just suggests that maybe have some patience before stepping into the hyper defensives.
Cameron, great having you on the program. Very smart analysis. I'm going to put the freight index on my dashboard now so I can watch it more closely. Cameron Dawson there of Newedge Wealth. A check on futures, not plummeting, but we are seeing increased drops. Now down 0.25% on the S&P. NASDAQ futures down about 1/3%. Let's get a look at the individual names moving ahead of the opening bell. For that, we go to Abigail Doolittle. Abby?
Matt, one stock not contributing to the small decline for the indexes this morning. Constellation Energy surging up about 12%. This, of course, after they said that they're reopening 3 Mile Island because of demand from Microsoft for AI. Microsoft had agreed to buy their electricity to supply a growing fleet of data centers. Microsoft down ever so slightly, but because of its big weighting, the second biggest weighting to the S&P 500, the NASDAQ 100, this is a piece of why those indexes are down just a little bit. PepsiCo falling. This is Morgan Stanley has cut shares from an overweight to an equal weight off the lows, down about 0.9%. The analysts there had upgraded shares not so long ago, now downgrading, saying that there's less than 6% upside to their price target and that there is EPS risk to earnings, the company meeting those earnings due to lingering concerns around stalling growth. And then finally, GM, Ford, and Stellantis all down. This, of course, as UAW is warning of potential strikes at Ford and Stellantis, at least. So GM, a bit of a sympathy trade there. And, of course, this a year after the unprecedented work stoppages last year. It'll be interesting to see if that happens again, Sonali, especially with Boeing, the Boeing strike. It seems that those auto strikes last year perhaps set the tone for the current Boeing strike.
Tough trade in the mobility sector there. Abigail, we thank you so very much for keeping an eye on it for us. Now, coming up, we're going to go to retail because Nike pulls out one of their veterans out of retirement. But can he be the one to turn things around? We're going to get into that story next. This is Bloomberg.
Let's get now to high interest to look at what's making headlines around the world. Israel carried out extensive airstrikes across southern Lebanon yesterday, stepping up hostilities against Hezbollah. Hezbollah's chief blamed Israel for explosions this week in hospitals, in pharmacies, and other civilian-populated areas after pagers and walkie-talkies exploded around the country, injuring thousands and killing dozens. The owner of the now shuttered 3 Mile Island nuclear reactor in Pennsylvania will invest $1.6 billion to bring it back online, selling 100% of that output to Microsoft. The tech giant is looking for carbon-free electricity for its data centers so it can power its AI needs. And New Yorkers, it happens every year. The United Nations General Assembly convenes in Manhattan. It's worse than SantaCon, and sets off a wave of road closures and police escorts, completely snarling traffic. This time around, it's set to be particularly bad, with trains seeing 50% more delays this summer over last. The city has declared a gridlock alert for the whole of next week.
And we're watching shares of Nike extend gains after the sneaker giant replaced CEO John Donahoe and brought in veteran executive Elliott Hill out of retirement. This is all part of an effort to return the struggling brand to its glory days. Here to tell us what the street makes of the move is Cristina Fernández. She is senior research analyst at Telsey with an outperform rating on Nike and a price target of $100. How does this change the game? You see the stock market reacting pretty significantly. You actually also see many of Nike's rivals trade lower on the heels of this announcement as well. How much faith is there in this new executive returning?
Yeah, I definitely see it as a positive for the stock. Nike is the strongest player in the sector, and Nike returning back to its roots, it's really, it's good for the company. Where Nike has strayed is really on product innovation. So they need to bring new product to market. They need to rebuild relationship with the wholesale partners and have the product more out in the marketplace and bring back its marketing prowess. So they've strayed a little bit away from that over the past couple of years with the CEO who was really more focused on making Nike a more technological savvy company, and they lean really, very heavily into DTC. And now, they started to pull back and go back to what worked with them in the past. And I think by bringing someone who was at Nike for 30 years, knows the companies really well, knows the inside out of the industry, the employees, the partners, it gives them a good opportunity to get back to what has been successful for them over many years.
I'll never forget my first pair of Nikes. In the 4th grade, they were so cool, and everybody had to get a pair, Cristina. Then we got Reeboks, and then there were British Knights. There was a brand where you, pumped them up. There was Puma. All of these things end up being a flash in the pan, right? Are Hoka and On Cloud, or whatever it's called, are they really lasting competition to a behemoth like Nike?
I mean, there are definitely competitions in pockets of the sector, right? Where they've been doing really well is on the everyday runner. But Nike, when you look at Nike, a $50 billion company, they play in pretty much every sport, and they've been, very strong in basketball. They dominate here in the U.S. They're strong in soccer, every team sport, and all the individual sports. So those brands, I see them definitely competitive in particular pockets of the sector, but there's not many companies that can, compete with Nike across the universe. Adidas is probably the one that can do it best, and they're about half the size of Nike. So, there are brands today that are, like the ones you call out, and then also Adidas has been doing really well on the lifestyle shoes. So, there's definitely there's always trends in this industry. Some products do better than others in different cycles, but, Nike definitely has the advantage just given their size and scale.
Right. Tell us more about this industry. What is the moat here? Because to Matt's point, I'm one of the switchers, actually.
You wear British Knights?
Very Nike. I had 7 pairs at one point in every different color. I have moved to OnCloud. I'm a runner as well. My store makes me choose much more, safe shoes.
That's Federer's. It's Federer's brand, right?
So, well, that's the point here, Cristina. If you have to kind of really pay for brand awareness a little bit by these, multi-million-dollar deals with athletes, for example, what is the moat to this business, and what advantage does Nike have at this point in time?
Yeah, I think the moat with Nike has been their product innovation, right? That it's unmatched given their scale. It's been their marketing prowess with the endorsements. I mean, when you look at their roster, they have, a lot of the best athletes in the world, and, having space across the marketplace, so not just their own DTC, but also having, like the Foot Lockers, the Dick's, everyone else below them, the Macy's, the Kohl's, really show their product in a good light, and being able to segment the market for different customers, and doing that, time and time again. And that's, it's easier to do over a short period, but hard to do, year after year. But that's what they need to get back to. And they lost a little bit of that during the past couple of years.
I mean, I can't remember if it was Phil or Mark Parker, but I was reading one of the notes to the employees from a Nike founder who said, like, we've got to get back to the groundbreaking sneaker technology, which, you know, sounds like a pretty silly phrase, but it's really to Sonali's point about the people, right? Will there ever be another Michael Jordan for the shoe industry? I mean, is it possible that he could be eclipsed? Am I just, you know, old and, you know, nostalgic?
Yeah, I mean, I think it's probably hard at that level, right? Like Jordan is a $5 billion brand, so it's probably hard that you're going to have one athlete that can grow a brand like that and have his legacy, but it's really about the accumulation, right, of different athletes. So they have, you know, LeBron that has his line. They have other athletes that they're newer to the brand that they've done well, the Tatums, the Lucas, and, you know, they're doing more in women. So I don't think they're going to have, you know, one athlete that's going to be as dominant as Jordan was, but just, you know, a whole range of athletes that together can drive innovation over time and, you know, and drive sales year after year. And that's really on the performance side, you know, the lifestyle, which is also a big part of the business. It's really more trend driven and going back to the archives of time and trying to bring new trends to the market.
Yeah, I like those 1997 Air Max for runners. Those are good. Cristina, thanks so much for joining us. Cristina Fernández, Telsey Senior Research Analyst, talking to us about Nike and really the sneaker industry at large. Coming up, we'll talk about tech and Apple. It's facing an unprecedented challenge, persuading customers to buy its latest iPhones without its newest feature. Social climbers next. This is Bloomberg.
And it's time now for Social Climbers. The company's making waves this morning. And first up, Johnson & Johnson is boosting its offer to settle thousands of lawsuits by people who say its baby powder gave them cancer. The offer was raised to over $8.2 billion, up from $6.5 billion. J&J maintains that its powders never caused cancer and that it appropriately advertised its baby powder. Next, Palantir won a $100 million contract that would let the company offer AI tools to a larger portion of U.S. military personnel. Palantir's Maven Smart system uses AI and U.S. intelligence data to create battlefields on digital screens. The U.S. military used the system to help identify targets for airstrikes in the Middle East this year. Finally, the newest Apple iPhones hit stores today. The line was out the door for the Fifth Avenue stop. It is only missing one thing, though, the AI software that the tech giant has been touting since June. Users will have to download the software features over time as they become available during the coming weeks and months. You can follow all the latest company buzz on TRAN Go on your Bloomberg terminal. This is Bloomberg.
All right, we are moments away from the start of trading on the last trading day of the week. This is Bloomberg Open Interest. I'm Matt Miller. After a day like yesterday, you might be tempted to just sell and take a long weekend, and it looks like maybe a lot of people have done that, right? Here is a look at futures, S&P futures and NASDAQ futures down about 0.33% after a new all-time high on the S&P yesterday. Absolutely soaring in equity. The equity trade yesterday up 1.7% after a 50 basis point rate cut by the Fed on Wednesday. Feels like you could end it early. These guys are still going to work at Innovex. They're ringing the bell on the New York Stock Exchange. Down on the NASDAQ marketplace, Voyager Acquisition Corp ringing the opening bell. But in terms of the market, it does look like we're taking a little bit of a breather. Could be the FedEx warning and profit miss that is weighing on these indexes. You can see the cash trade now just opening up down about 0.1%. The Russell opening down 1/3%. But we've had some good news as well. We were talking about Nike getting a new CEO, and after they paid Phil Donahoe $104 million over 5 years, they kind of need it, losing out to competition like Skechers and what is it? On Cloud and Hoka. I can't even keep up with the sneaker fads anymore, but you can see the stock up 7.5% right now. We are also looking at HPE, Hewlett Packard Enterprises. Those shares have been on a winning streak lately, beating the S&P Tech Hardware Index. Earlier this week, Bank of America upgraded HPE to a buy from a neutral. The upgrade cited its Juniper deal. And just to clarify something we were talking about on Tuesday, when the deal was announced earlier this year, HPE did say at the time that it had already secured all the funding commitments necessary to make it happen. Sonali?
Yes, Matt. Keeping an eye also here on Lennar, the home builder dropping on an earnings miss as high mortgage rates cut into affordability for buyers, and Lennar down 3.6%. We'll talk a little more about that housing market in a second here. Also, we'll talk more about FedEx. It is lower after saying its business would slow in the year ahead. It reported a worse than expected quarterly profit. We have FedEx shares at the open down more than 13%. We're going to take a closer look now with Bloomberg's Abigail Doolittle.
And take a look at this plunge, Sonali. This really puts it into perspective, just this deep dive, down 13% for the shares of FedEx, as they did, as Sonali just mentioned and has been mentioned all morning, cut the full year outlook. What's worrisome about this is it a negative signal for the economy, especially after the Federal Reserve just cut by 50 basis points. One of the only times they've done that in a non-emergency time. Is the Fed seeing something that they didn't talk about that brought that cut that would be supported by the idea that this giant shipper has cut the outlook? The CEO, in fact, saying that it was a challenging quarter and then going into the outlook. So the EPS miss was massive. They put up $3.60 versus the estimate of $4.77, a big revenue miss as well. They lowered the full year view on both the top and the bottom line. And then they're also seeing some cost reductions. This could be a positive, but it's not filtering through to the numbers yet. In terms of the revenue growth that we're seeing, it's not dramatic when you take a look at it from this version. In fact, you could say that numbers had been moving in the right direction. But I think what folks really don't like here, Matt, beyond the fact that the outlook was reduced, is now we're moving back in the wrong direction again, even though it's not so dramatic. But I think that the bigger piece of the story here is it some sort of warning here on the economy? Yeah, absolutely. That's always the worry when you get a FedEx or a UPS warning or missing on profit. Abigail, thanks very much for that. Abigail Doolittle there talking us through what's going on with the FedEx release yesterday and the kind of cratering that we've seen in the stock today. Let's talk, though, about the record we hit yesterday after the Fed's 50 basis point cut. With us at the desk is Ironsides Macroeconomics Director of Research, Barry Knapp. Barry, great to have you here. Sonali and I spent a lot of time talking about how September is the worst month of the year for stocks. And we did have the worst start to a month since like the 50s. And yet, here we are at an all-time record high in the S&P. Is it warranted?
No, I don't think so. We've got, three major concerns to deal with: the economy, earnings, and the election. And the range of outcomes are all skewed quite negatively. Obviously, the FOMC recognized that, which is why they went 50 instead of 25. Had been our call, primarily because the range of risks around the SOM rule and the labor market, I've been describing it as negative convexity. That's sort of an old derivative, saying. But the idea was, it's basically what Bill Dudley's been saying, which is the real lesson of the SOM rule is once the unemployment rate goes up 50 basis points, the 3-month average of it, it's never stopped at just up 50. So that even the Fed's forecast this week of it going to 4.4 and suddenly just stalling out there because they stick the landing is a fairly low probability outcome. And fortunately, the Fed did decide, okay, we're not going to bet that it's different this time. And so they took out that insurance. But they really do need to get the policy rate to 4 in short order to stop what I would consider to be a recession in the small business sector. We saw that in the first estimate of the annual benchmark revision and how much the birth-death model's been overestimating small business employment. But they have to stop that from becoming systemic, bleeding into consumption data and the earnings.
How do you think, Michael Feroli was on the close yesterday, and he has another 50 basis point call in November.
I agree.
You agree?
I do. I think we're going to get 2 week employment reports that So if you just take that benchmark revision and you assume that that pattern's continued since March, which is a pretty good assumption, it may even be a conservative assumption because demand for large corporate employment has weakened as well. So small business employment could be even weaker. Employment growth is now down to 80 basis points annualized. The last 3 times that happened, in 90, we were already in a recession. In 01, it was the month the recession started, and in 07, we were 4 months away. So again, I've been arguing for some time that the way the Fed went about the tightening cycle was all wrong. They eased primarily through their balance sheet, and when they tightened primarily through rate policy and only passively unwound their balance sheet. That caused the deepest yield curve inversion since Volcker.
Are you saying that they should be tightening more through balance sheet reduction?
100% they should have tightened more through balance sheet reduction. Now, there's a couple things they could have done. They could have sold mortgages outright at the beginning of the process. Jamie Dimon alone probably would have taken $250 billion or something. They needed the assets at the time. But what they should be doing, could have done, and should be doing to this day, is instead of reinvesting into longer-term securities, any treasury that matures, they should be putting in treasury bills. The Fed had a bills-only policy from 1951 to 2008. They should not be influencing those longer-term rates. So if you're a large non-financial corporate who borrows out the curve, you're benefiting from the Fed owning better than 20% of the mortgage, tips, agency MBS market. That's also suppressing credit spreads. So you're able to borrow attractively at rates that the Kansas City Fed estimates are at least 1% lower than they would be otherwise. But if you're a floating rate borrower, you go to a small bank, you are a small bank, you're a small developer, your conditions have tightened decidedly.
I want to talk about the spillover effect there that has into sectors, because you would have expected perhaps the banks to rally more on the heels of that decision, but a lot of people still concerned. Also to see real estate lower today after that Lennar report is fascinating. Barry, there are a lot of people who think that if rates are lower, then mortgage rates are also lower, and there will be fresh demand that would put housing prices higher. But there's another camp who believes that that reset could push prices lower, actually. Right. Where do you stand?
Yeah, it's a complex discussion. It does relate directly to my criticisms of how the Fed tightened because, my old colleague Steve Kim, now at Evercore ISI, Steve maintains that 70% of the supply of single-family homes comes from small mom-and-pop builders. Conditions are exceedingly tight for them. They have to go to, Alpine Bank in Avon, Colorado to get their financing. The rate's gone up considerably. But if you're Lennar or D.R. Horton, you can sell longer-term duration debt at a tight credit spread, do a mortgage buy-down, and so they benefited. So people would look at the builders and go, the housing market's fine. It's not so clear it's really fine. And the question that you raise, will it increase supply as they cut rates? It will increase supply, the new home supply, if conditions loosen for those small mom and pop builders. But, 50 basis points isn't going to do it, right? You're going to have to cut at least to 4, in my opinion, to ease the pressure on small banks. And then you have the question of whether you'll get existing home sales supply, whether people will be willing to move. And if you look at the Fed's balance sheet as an example, sort of a microcosm of what the household sector looks like, there's been very little change in their monthly runoff, even though mortgage rates have gone from 8 down to below 6. So I'm not so sure that people are going to necessarily be willing to move and loosen up the market, increase supply,
Barry,
without a big move in rates.
Stick with us. We're going to talk more about these spillover effects from the Fed's rate decision. But first, coming up, a bullish PepsiCo analyst goes sour on the stock. He says his call was wrong. We're going to give you details of that today in today's top calls. This is Bloomberg. Time now for the Wall Street beat. Apollo cinched $5 billion from BNP Paribas as it looks to grow its credit business for the long run. Bloomberg's Allison McNeely reported on this, joins us now. On one hand, if you're Apollo and you have a credit business that's more than $500 billion, what's another $5 billion to you?
I mean, it's really about another $5 billion to do $5 billion more worth of deals. We've been reporting over the past year about how Apollo has been trying to bring in more forms of financing for its credit business, in particular Atlas SP, which folks may know as the Credit Suisse Structured Product Group, the entity known as, or formerly known as. They got some minority equity from MassMutual, from an affiliate of Adia, and now they're bringing in a big European bank.
This Atlas unit has been pretty impressive in that it really struck deals immediately. You thought about them kind of diving into that regional banking crisis early on after that Credit Suisse deal. So how big will this really be to Apollo? How is it changing? Because they've been forming new leadership there, haven't they?
Yes, it's part of a shift to try and increase the amount of debt that they can originate and the number of deals that they can do, and really just kind of, I think, showing Wall Street that they have partners all over the place and sort of a show of confidence for the business.
I think it's also important to differentiate here, and there's a quote here from Jim Zelter, Apollo's co-president, saying this is one of the, if not the largest ever, long-term private credit financings. Apollo kind of has been really marketing this differently lately. Investment grade, safe stuff. Why is that so important right now? Because we are seeing so many more headlines of private credit stress and defaults.
Totally. I mean, this is probably the biggest issue that Apollo contends with in all areas of their credit business. How safe is private credit really? What is private credit? What is in private credit? Because for a long time, we thought about it as being higher yield, riskier, stuff that couldn't get financed by the banks. And so they are going to great lengths to explain, no, we're actually just an alternative to the banks. Our product is safe. Our lending is safe. It is an investment grade.
We will not lend to those below a certain credit rating. Allison, we thank you so very much for your time. That is Bloomberg's Allison McNeely, all over one of the bigger scoops of the day. Let's take a look at markets before we head to break here, because we are looking at erasing some of those gains from yesterday. That brought us, Matt, to record highs. You now see the S&P 500 about 1/4% lower.
Yeah, but still at 5,700, right? So we're still almost. We're still at a very high altitude and not seeing big drops. I get the feeling that a lot of people, there was such a build-up to Wednesday, and then you got the big cut, and then yesterday with this huge rally. Why not get neutral and go to the Hamptons? Like, it makes a lot of sense.
Or maybe you're a little worried because you have small caps trading 0.8% lower. It's like Barry Knapp says, we're trying to avoid a small business recession, he believes.
Yeah, well, a lot of talk about the rolling recession. Coming up in the next hour, Emily Roland on the Fed, shifting its focus more to the employment mandate. This is Bloomberg. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Sonali Basak. Katie Greifeld is off today. And coming up, a note of caution sets in as the market euphoria that followed the Fed's big rate cuts now fades. And a warning sign for the U.S. economy. FedEx falls as the shipping giant sees lower business in the year ahead. And the CEO of generator maker Generac joins us in the C-suite to discuss the challenges facing America's power grid, Matt.
All right, let's get a check on what's going on in the markets on this Friday. It feels a little calm. Arrows are red, right? We see a drop of 1/3% on the S&P 500, but to 5693. So it's still higher than the all-time high had been before yesterday. The NASDAQ 100 is down 0.4%. The U.S. 10-year yield soaring.
Oh, please.
More than 3 basis points.
The 2 years up by even more. Fun fact.
And what, like 5?
Like 4.
Okay.
But, you know.
All right. So basically not a lot of movement, but you see investors are selling stocks and bonds today.
They sure are. We're going to watch FedEx this morning. It's one stock to keep an eye on. It's the worst performer in the S&P 500, down now almost 15%, Matt. It is setting down certain sectors in the S&P 500 as well. It's interesting. Home builders, real estate, a lot of kind of tough tones underneath the market. Remember, FedEx itself had a worse than expected quarterly profit. The CEO citing a challenging quarter and slower business ahead. It underscores lingering risks to the the financial.
It's a bellwether, right?
It's a
so
bellwether.
We watch this stock to tell us, to give us a sign about the broader economy. Joining us now to talk about that is our economist, Anna Wong. She's the chief U.S. economist at Bloomberg Economics. It's great to have you on, first of all, because you were right about the Fed. So congratulations.
50, unlike many others.
On the 50 basis point call. And, you know, a lot of people, viewers were writing to me like, oh, I'm worried that this 50 basis point move, a double rate cut, means something bad about the economy. And then we get the FedEx warning after the bell yesterday. Does that also mean something bad about the economy?
Yeah, I think the economy has been going through a two-track kind of growth path. So on one hand, you have services doing very well, and which is what FedEx won't be able to capture because FedEx really is measuring the goods economy. So the goods economy is not doing well, and it has not been doing well for 2 years now. So if you look at box orders, card box demand, it actually has been in recessionary levels since 2023. So FedEx pessimistic earning call is a continuation of that. And it also reflects the fact that Germany is not doing well, China is not doing well. So in terms of global trade, it's not looking great. So that's what that's capturing.
Is this kind of the tail wagging the dog? How much does it matter here to see that weakness in the goods economy? And at what point does it spill into services as well?
Yeah, so during the pandemic in 2020, 2022, households were buying lots of electronics. So a lot of these goods company put in a lot of investment, just bought in a lot of inventory, and it took a couple of years to unwind that. And also consumers are also continuing that shift away from goods towards services. And so in part, that's what we're seeing. But generally, I would say that, yes, there is an undertone of weakness in the economy that Powell was underplaying.
We're going to go to Emily Roland at John Hancock in 1 second, and we're going to talk to her about the Fed and shifting focus to the labor market. Let me get, in just 10 seconds, your labor market call.
I think the labor market is extremely weak right now, and job growth is probably flat to declining in the last 3 months.
All right. Anna, thanks so much for joining us. Anna Wong there at Bloomberg Economics. Let's get some more insight into the markets. As I said, we're now joined by Emily Roland, John Hancock Investment Management Co-Chief Investment Strategist. So you heard it there, Emily, from Anna. She thinks the labor market is extremely weak, and that's why the Fed, I guess, felt inclined to do a double cut on Wednesday. Is that your view? Is that your worry as well?
Yeah, I mean, I think the Fed wants to prevent any further weakness in the labor market. We've heard that loud and clear from Powell starting back at Jackson Hole, saying that they would not welcome any further deterioration in the labor market. And we're seeing those cracks forming. The last couple of jobs reports, not great, especially if you looked at the revisions, but initial jobless claims are really the most timely read on the economy. Nothing's perfect, but we would be watching that on Thursdays. Right now, they're really well contained in the low 200,000s. I think if you saw that bumping up on 300,000, that would be a bit more cause for concern. It would likely cause high yield bond spreads to widen and a broader volatility environment to play out for risk assets. But so far, that remains intact.
At the end of the day, Emily, what does this mean for a spillover effect? If you have so much kind of fear under the market, I can't really get a gauge here. You had the S&P 500 hitting another record just a day ago. Of course, we see that weakness today. It is not erasing the gains that we saw. We are still up on the week. How much fear is under the surface? And is any of it really priced in? Is there a risk here that a slowing economy could be much more pronounced and that would drag valuations down along with it?
Yeah, so Sonali, it's really interesting. When I'm out talking with investors every week, they're telling me that they're fearful. I'm not seeing a lot of bullishness, but of course that's not being reflected in the cross-asset action that we're seeing with equities near all-time highs. You see areas like small caps ripping, really reflecting the idea that markets are still sunning themselves on soft landing island. And I think we could stay here for a while, again, as long as initial claims remain contained, as long as high yield bond spreads don't widen out. Borrowing costs have come down for lower quality companies. The broad high yield bond market is yielding just over 7%. That's the lowest level since 2022. So borrowing costs are still cheap. If we see high yield bond spreads widen, that probably reflects a greater concern around liquidity or some type of financial accident. I think at that point, you could see volatility playing out. The other thing I would say is that now the Fed's got to actually cut. So the bond market's pricing in a total of 2% in cuts over the next 12 to 16 months. And if they don't do that much, then essentially they're tightening. So the bond market's expectations here are quite meaningful. And I think the Fed needs to deliver in order to keep the party going here.
I told you, we never talk about gold. Right?
Okay, let's talk about it.
Well, gold's at a record, and I'm just thinking about it because you sent the Michael Hartnett note to me this morning from Bank of America. He says to buy bonds and gold as bubble risk returns. Emily, do you agree? I mean, we see the market still pricing in more cuts than the Fed shows us on its dot plot. He says investors are pricing in now 18% earnings growth next year. I mean, are you seeing investors chasing these records, and is a bubble forming?
Yeah, I mean, right now, momentum is a powerful force, and that we're seeing this kind of sentiment-driven rally on soft landing hopes, and momentum could take that further. But I think your point about gold is a really interesting one. There's a few things going on here. One is as bond yields come down, gold becomes a bit more attractive here on a relative basis. If you're looking for a more defensive allocation, you're also seeing, geopolitical risk, of course, is going to be permeating markets over the next couple of months here as the U.S. election approaches. So there typically is a bid for gold during periods of potential heightened geopolitical risk. But I would say the kind of underappreciated factor here, too, is that we have seen this weaker dollar environment. Investors are pricing in a more aggressive Fed cutting cycle versus other central banks across the world. And typically rallies in gold do come with weaker dollars, weaker dollar gold rallies. And I think that's also provided some support. So as we look across commodities, gold would be probably of our favorite areas to look. And you could see continued momentum as it relates to that trade.
It's interesting because when you look at the commodity complex, of course, gold has been much more bought because of all the reasons you're saying. On the flip side here, we are seeing actually the S&P 500 energy index being the biggest loser of today, more so than industrials, where you see that FedEx pain, more so than materials, financials, and real estate. Talk to us about the energy sector for a minute here. You've seen this in prior years be a real leader in how you've seen the S&P 500 progress. What role does it play moving forward?
Yeah, Sonali, it's all about demand slowing. And Anna, your reporter prior to this conversation, was hit the nail on the head when she was talking about slower economic growth in China. We see China as no longer being the growth powerhouse of the global economy. We look at areas in Europe like Germany, which are, the manufacturing PMI right there is about 42, which is recessionary territory. No doubt about it. So we're seeing global demand really hit the commodity complex. And, as we think that that's going to see some more deterioration. So energy would not be our favorite sector for an environment in which global growth is decelerating. We'd want to wait until the contraction plays out and we start a new cycle to overweight energy and other more cyclical parts of the market.
Wait, what is your favorite sector?
So U.S. mid-cap industrial stocks. I know that's very specific, but we're looking at a lot of trends around onshoring, reshoring activity, supply chains coming back to the United States from other parts of the world. We're also seeing a ton of fiscal spending. And that's heading towards areas. We talked about the outperformance of industrials versus energy. A lot of that is because of things like the CHIPS Act and the Inflation Reduction Act, the Infrastructure and Jobs Act. All of that's being funneled into new EV and semiconductor production in the United States. The U.S. Midwest is booming right now. We're seeing a manufacturing renaissance there. Mid-caps have almost a 20% overweight to industrials. That's really the sweet spot for us in terms of playing that trend.
I got to ask, Emily, if you're at all worried when you look at Germany or at Intel, right? Because I know we're funneling billions into EV production in Detroit and putting up Intel plants in Ohio, but are those things going to really work out?
Yeah, instead of actually playing those companies, we would be looking at the companies in the U.S. in the mid-cap space that are actually part of the sort of ecosystem around the investment that's happening. So if you think about a company that's involved in the trucking, the building, the transportation around these themes in the heart of America. That's really the play to us and where you can get the biggest benefit. And I'll tell you, industrial's earnings growth tends to continue to accelerate even into a recession because these are long-lived projects. So we think that there could be an angle there as well.
Emily Roland of John Hancock Investment Management. We're going to take a look at stocks moving also this hour. Abigail, Matt has things to say too, but we'll go back to you in a minute.
We don't talk about Germany that much. Obviously, we're focused on U.S. equities on this program. But the German automaking sector is in a world of hurt. And so I mention it in passing as if everyone else knows. And I just want, Mercedes had another
it's completely
profit
fair.
warning. Yeah.
It's completely fair because you also have U.S. companies exporting to Germany, and you think about that slowdown in China. You got to worry about what's going on in the rest of the world. That will be our theme for next week, Matthew Miller. But Abigail is here to tell us about what's moving. Abby.
Well, one stock that's moving, Lennar, the home builder, down 4.4%, the worst day since June. This after they, on the surface, earnings and revenue beat estimates, but the growth for new orders slowed. I think it was up 5%, so less than what analysts were looking for as high mortgage rates weigh. These home builders are going to be very interesting to check in quarter after quarter as the Fed is cutting, and the impact of that on mortgage rates. Will it spur demand? Turning to the shares of Nike, they are popping sharply higher, possibly even it's appropriate to say that they're surging. And this, of course, after an executive change was made, not surging, popping, up 5.4%. They're bringing in long-term veteran Elliott Hill out of retirement and retiring the current CEO, John Donahue. Folks are really hoping that Elliott Hill, as CEO, will be able to bring up the company back to its former glory to compete with the likes of Hoka and some of these other sneaker brands. And then finally, Constellation Energy. This stock is surging, up 13%. This after they said that they're reopening 3 Mile Island to meet the energy demands of Microsoft for its AI. Microsoft down about 0.6%. But of course, yesterday there was that big tech rally. So a little bit of an easing there overall, Matt.
I got to say, that's probably my favorite story of the day. I mean, one of those reactors at 3 Mile Island has been closed since like 1979 when it melted down. The other one ran until 2019, and now they're going to bring it back online just to provide Microsoft with power. They've decided they're going to buy all the electricity that comes out of it for 2 decades, Abigail.
It's pretty stunning. When I first heard it, I was a little bit surprised. It doesn't entirely make sense in some ways, but you have to guess that the people who are making these decisions, that they're seeing something that maybe we're not, with a little bit of this disbelief.
Well, they want carbon-free energy, right? They shut it down because natural gas was much cheaper and nuclear was just too expensive. But natural gas is not carbon-free. Abigail Doolittle, thanks so much for joining us. We'll look at some of those stocks. Coming up, Kamala Harris taps Oprah Winfrey and a bevy of Hollywood A-listers in a push to rally momentum. The latest on the race to the White House next. This is Bloomberg. Let's get out of high interest to look at what's making headlines around the world. What should be a big day for Apple is actually posing the company an unprecedented challenge, convincing customers to buy its latest iPhone without including its newest features. The iPhone 16 is launching in almost 60 countries today, including here in the U.S., as well as China and India, but the device is missing its much-touted AI software, which doesn't get pushed out until next month. Meanwhile, Pope Francis told Roman Catholic cardinals they need to trim the fat a little, tighten it up, and help the Vatican reach its zero deficit target, which it set actually after a series of financial scandals. A letter published on the Holy See's website said all Vatican institutions need to find external resources for their missions. And Kamala Harris's campaign had some star power yesterday thanks to Oprah Winfrey hosting the vice president at a virtual town hall in Michigan. Apart from hitting some core campaign themes in what was an emotional forum, other stars helped the Democratic candidate to generate buzz around her campaign, including Meryl Streep, Chris Rock, and Jennifer Lopez. And Sonali, Kamala said, if anybody comes in my house, they're going to get shot. Talking about her gun ownership. I thought it was pretty interesting.
She has been talking about that more in this campaign. It was surprising at the beginning, but we're going to talk more about this race for the White House with Bloomberg's Balance of Power co-host Joe Matthew. And you think about this part of the campaign trail right now. You think about Kamala Harris just last night. You even think about Donald Trump earlier this week in Long Island and looking to court perhaps voters that were not on his side initially. How do these two candidates really appeal to the people who may have not voted for them otherwise?
Well, they're trying in their own ways. I mean, here I am. I'm glad to finally be on the show with the cool kids, and I suspect that's how Kamala Harris felt last night with Oprah Winfrey and all the stars that Matt mentioned. It was curious to see Donald Trump in New York, Sonali, because that's a very blue state, and it's not likely that he will win there. It's kind of curious whether he's just trying to draw dollars from Kamala Harris or actually make a stand in the Empire State. It's not one that has gone for a Democrat, for a Republican, rather, in a really long time. But you're getting to the point here that the two campaigns are fighting over a very thin slice of pie here when it comes to undecided voters, and they're really in the 7 swing states that we're talking about. That virtual event with Oprah Winfrey could have been done anywhere. They could have done it in D.C. or New York, but they did it in Michigan, and it's no mystery why. She'll be back in Madison, Wisconsin later on today through Georgia, as this map offers very few lanes for either candidate to close the deal.
We had, I feel like, kind of disturbing reports about Republican governor who has touted himself as the black Nazi on adult websites, and Donald Trump had closer ties with this guy. What's the story there, Joe?
You really want me to talk about this? Mark Robinson is his name. This is the Republican lieutenant governor in North Carolina who, as of midnight last night, is fixed on the ballot as the Republican nominee for governor. The term-limited governor, Roy Cooper, who's going to be joining Anne-Marie Hordern a little later on today on Bloomberg, is on his way out. They were elected separately. Those are two different elections. Just for a little background there, the way this works in North Carolina. This is the only Democratic-held governorship, Matt, up for election in this race that was won by Donald Trump in 2020. One of the most expensive in the country. And now you have the Republican nominee in a CNN story referring to himself as a black Nazi on social media, referring to himself as a perv on websites that we can't describe here on Bloomberg TV and radio, bringing up some real questions about the future of his candidacy. He says he is not dropping out. But North Carolina is a one-point race, like a lot of swing states. And it may not be a good thing for Donald Trump, who's trying to win that state as part of his map.
Joe, I would also love for you to switch gears here and really comment on a story that had crossed the wire just a little earlier about the Supreme Court spurning the Green Party on Nevada's ballot, aiding Harris. Can you speak more to the significance of this?
Well, we're hitting all the swing states today. I mean, Nevada's an important one here. It's not a lot of electoral votes, but it's part of the equation. And again, we're talking about a race that's down to 1 or 2 points, depending on the poll you're looking at. In terms of our Bloomberg News swing state poll, a 3-point race, 48 Harris, 45 Trump. And now Jill Stein apparently is not going to be on the ballot. The U.S. Supreme Court siding with the state Supreme Court in Nevada to make it clear that the Green Party nominee or candidate will not be on the ballot here. This has to do with signatures. I'll just explain quickly. They were accused of not getting the proper requirements here to attest that each signatory was, in fact, a registered voter in their county of residence. So no Jill Stein. That means another point or two potentially in Kamala Harris's corner, and it's so tight there that that might be enough to make the difference.
All right, Bloomberg Balance of Power co-host Joe Matthew, thank you so much for joining us. It's storytelling time, as you often say, Joe. And, you know, there's no other show that I watch or listen to every single day than A Balance of Power.
I listen to it on my car ride home, and you should, too, for everybody else. For
the latest on the U.S. elections, you can type ELEC GO on your Bloomberg terminal. WSL elections. We have a new one, WSL space elect map. I think we have the best election dashboard in the industry, and I highly recommend anybody privileged to have a Bloomberg terminal should be using that power.
And everyone who doesn't, go to Bloomberg.com because we are up to date with all the latest for you.
Still ahead, M&M's is introducing a new flavor that's melting the internet. Social Climbers is next. This is Bloomberg.
And it's time now for Social Climbers. The company's making waves this morning. And first up, new CEO of Starbucks, Brian Niccol, addressing employees for the first time, saying that the staff should be together in the office as much as possible. Niccol's own work arrangement allows him to live in California and to travel to Seattle on the company's corporate jet. Next, Eli Lilly is asking people who took copies of its blockbuster weight loss drug to give the company access to their medical records for safety reasons. The move comes as Lilly builds a case against businesses selling the compounded drugs. Finally, it's peanut butter jelly time for M&M's. The candy giant Mars is introducing a new peanut butter and jelly flavored M&M, and it will have an outer berry flavor with a creamy peanut butter center. The new flavor will hit stores in December. You can follow all the latest company buzz on TREN Go on your Bloomberg terminal. Matt, I only eat peanut butter M&Ms. A fun fact for you.
You know, normally when we have a story about a new food item, it's usually something disgusting. That sounds absolutely delicious. Coming up, with extreme weather warnings on the rise, Generac CEO Aaron Jagdfeld joins us. Coastal weather warnings this morning might make you ask if you have a backup plan for your home or business in case an emergency knocks out your power. Microsoft just contracted a decommissioned nuclear power plant on 3 Mile Island, which is being revived to fuel the company's AI business. Constellation Energy, as we've been telling you, is going to invest $1.6 billion to bring the TMI-1 reactor back online by 2028. But you might not need to what a multi-trillion-dollar multinational corporation does. Instead of a nuclear island, you might find a slightly smaller, less expensive diesel or natural gas-powered generator from Generac gets the job done for you. Here to talk to you about your backup plan is the CEO of Generac, Aaron Jagdfeld. Aaron, I thought it was great that you were coming on the same day that Microsoft was reaching for a big power supply solution. In terms of the weather warnings, though, they seem to be increasing. We're losing power more and more often in Westchester. Do you see your sales actually kind of rising in line with climate change?
We see our sales rising in line with lower power quality, Matt, which, obviously it's clear the science says, air temperatures are warmer, water temperatures are warmer. This is causing more severe weather, hotter droughts and heat waves and colder cold snaps, more rain, stronger hurricanes. These are the trends we've been witnessing over the last couple of decades. And, you put on top of that, then the stress that the grid is under. And, you've got companies like the Microsoft announcement this morning with 3 Mile Island. Companies are forced to try and find new power sources because the grid is, it's stressed right now.
Do you have more sales in those states? I mean, we're always doing stories on Texas with power outages because their grid is so fragmented and fragile. Do you see more sales in states like that?
Yeah, nationally, we're about 6% of single-family homes have a permanently installed home standby generator. Texas, actually, it's been a good state for us as of late in terms of demand. But some of our best states are not the states you might think of. Places like Michigan, where you've got pretty severe winter weather as well as severe summer weather. Ohio, Connecticut, you mentioned Westchester. Some of these states actually have higher rates of penetration of the product because they experience those multiple seasons. We're
showing the video of these portable generators that are gas or diesel powered. Mm-hmm. What I want for Westchester is the big built-in. They're like these portable ones you can get for less than $1,000, right? But the big daddies are like 30 grand.
Right, they're expensive, right? I mean, Aaron, at the end of the day, we have gone through a period of very stifling inflation. Have people kind of put off this purchase? Is this something that you find that there is kind of a hurdle here for many Americans to buy in for a new home?
There's no question. I mean, this is a home improvement project, right? So how you feel about your home financially, kind of where you're at, if you're locked into a mortgage that's a low rate today, but you want to move in the future, you're probably not doing big projects in your home today until rates come down. But we are seeing, again, when outages happen, so the product retails for around $5,000 to $6,000, and then it's another $5,000 to $6,000 to install it. So $10,000 to $12,000, it's definitely an expensive product when you talk about the overall cost. But these are fully automatic. They run off of the home's fuel system, and it's protection for your home, protection for your family. A lot of people are working from home now, right? So it can protect your livelihood as well. So we're just seeing these trends continue, and the product has become very popular.
What about businesses? When I was thinking about having you on this morning, I thought about a power outage at a hospital, for example, can be life-threatening. Do you have sales at big businesses or institutions like hospitals?
We do. Yeah, we have a whole division of our company that focuses on much larger generators for, exactly as you said, Matt, hospitals. They're focused on data centers, manufacturing plants, distribution, government installations like wastewater treatment plants, some of the critical infrastructure. We're big in the telecommunications industry. So if you see the wireless cell towers along the highway or along I-95, a lot of those are going to be backed up by our generators. And anywhere there's critical infrastructure where a power loss would cause significant damage or disruption to a business or to infrastructure.
How big do your single site contracts get? I mean, if I'm on the one end of the spectrum, right, I can go to, I guess, Home Depot and pick up a generator for a few $100. What's the biggest single site number that you've seen?
Yeah, I mean, especially you get into some of these hyperscale data centers, the Amazons, the Netflixes, and the Microsofts of the world. You're seeing some of these generator farms are upwards, to put it in context, they're sometimes 20, 30 megawatts of power. I mean, these are, again, this is why Microsoft's got a contract with a nuclear power plant, a defunct nuclear power plant, to bring it back online, because the amount of power needed for a single site is so dramatic. Now that's out on the far edge of the spectrum of use cases. A lot of times you're going to see for a typical grocery store or perhaps a manufacturing plant, maybe a couple megawatts of power to keep those installations running, which is, that's still a lot of power, but it's not nearly the size that you'd see in some of these bigger installations with the data centers today.
Aaron, we're getting questions from viewers as well. One being is, do you ever try to work with local electric companies to lower the cost for consumers?
Yeah, for us, we have programs with, especially when you talk about rural cooperatives where, the ratepayers themselves are part of, solving for what they pay for their local utility. It's a little bit tougher when you get into bigger, some of the bigger power networks and some of the bigger utilities. But definitely on the smaller utility side, we've put programs together in the past. I think that one of the things that people are very concerned about, and this is going to be coming, it's not just that power quality is becoming more challenging with the storms and some of the grid stress, but power prices are going up, right? So just what we pay every day for our electrical prices, that's rising. I mean, you've seen almost a doubling of power prices in some parts of the country over the last 10 years, and the forecast is for another doubling. So you're seeing people take the, kind of take the situation into their own hands, whether it's backing up their home or their business, or it's doing something to produce their own power like solar or wind or something like that.
Aaron, one thing I've been wondering a lot about is the stress on power grids across this country and what that means, that we've talked a little bit about climate change, but also as the needs for power increase so meaningfully with this, let's say, AI revolution. You were talking about rising power costs. I mean, would the cost of your products also rise meaningfully in the next couple of years also, given that stress and given these outages that we've seen? I mean, I've lost power in my home twice this season already.
Yeah, I mean, our products.
And I just moved in.
Yeah, I mean, our product costs have gone up like everybody, kind of with inflation here over the last few years. It's been tough. Things have leveled off now, but I think what I think homeowners and what business owners are very concerned about is where do their overall utility costs go in the future? We're investing very heavily in decarbonizing the grid right on the supply side, which is great. We're adding a lot of utility scale solar, a lot of utility scale wind in favor of some of the gas plants and some of the coal plants that have been traditional sources for power. And then on the demand side, you kind of hit the nail on the head. Sonali, we're electrifying everything. Like we're electrifying things in our homes, we're electrifying things in our business. We're just at the beginning of the electrification trends in transportation. And now you've got this whole artificial intelligence, a demand cycle here which is driving huge construction of new data centers, and that's going to put a lot of stress on the grid as well. So power prices are going up as a result. I think our products, by and large, get used for resiliency. So for those times when power's out. But I think the need for that, as the grid becomes under more stress going forward, we think that need's going to grow because we think power quality I mean, the data is very clear. Over the last 20 to 30 years, power quality has gotten worse in the U.S.
Well, Aaron, to your last couple of points, I mean, the rising cost of power and the green side of things, Microsoft is looking to nuclear because it's carbon free. You relaunched your solar and storage business, and Bloomberg Intelligence is focused on that and your EV charger partnership with Wallbox and Ecobee. How optimistic are you for this business, and does it matter who gets elected?
Yeah, that's a great question. I mean, obviously, I think it matters for a lot of us on a lot of points on who gets elected, right? And when it comes to power, of course, and power quality and the cost of power, I think from a bipartisan standpoint, we all agree on we want better power quality and we want to pay less for our power. So I think those things are agreeable points for the most part. How we get there is maybe where the details are different. But I do think that with our business, when it comes to some of our solar products, our battery storage products, you mentioned our EV charging products, Matt, this is about the future and trying to help homeowners reduce the cost of their power, right? By self-production, either on the rooftop with solar, but also having some amount of storage and the ability then to control kind of how those systems work together with your HVAC, your EV charging, all of those systems together to make sure we're maximizing your ability to have resiliency, but also to reduce the amount of power you use and consume.
Such a cool business. For the dad in me loves it. But Sonali loves it too, so.
I do. I want a generator before I buy other cool things.
Very cool. Aaron, thanks so much for joining us. Aaron Jagdfeld there, the CEO of Generac. Coming up, we're going to shift gears to food. A restaurant success depends on its food, but also its real estate. The CEO of Daniel Boulud's Restaurants, Sebastien Silvestri, tells us how offices and restaurants can help each other. This is Bloomberg. Time for our daily Wall Street Week conversation. Competition in the restaurant industry involves much more than good food. David Weston sat down with Sebastien Silvestri, who runs Daniel Boulud's restaurant group. He asked him what restaurants have to do to become successful.
We just rolled out a series of initiatives here at Daniel to continue elevating the experience. To stay at the top, we always have to continue elevating the experience. There's a lot of competition, so we cannot just stay still. And also a lot of reinvestment that needs to be done. These restaurants 2 years ago, we did a full remodel. We spent a few $1 million redoing the whole thing to make it look beautiful and bright and what it is. It's a landmark in New York City. It's one of the most incredible restaurants in the world. And so we always have to reinvest. And it's the plate, it's the uniform, it's the FF&E, everything that's something that people don't see. Sometimes the infrastructure, the art program in this restaurant play a huge role. We have Alex Katz all around us. It's $1 million of artwork in here. I think that's also something Daniel is very passionate about. So it's like art museum, quality art on the wall, and it's part of the whole experience. I think the ambience, the atmosphere, and so it takes a lot to do that. But I think always being the innovator, and Daniel has been there also with the food. I think one thing that strikes me the most is if you do a tasting with Daniel. And I love doing. I'm the business person. Really, sometimes I really don't have much to do when you have 7 or 8 the best chef eating and trying the food. But I'm part of it. I'll try, give my opinion. What's amazing is Daniel is like never satisfied with a dish. Like, you're gonna try it, and I taste it, and my gosh, this is the best things I ever had. I'm like, this is how that dish is supposed to taste like. It's amazing. But Daniel will always criticize it, but not criticize it because he's not happy with it. It's how do you make it better? And he's gonna push his chef. How can you make this dish better? Have you tried to do this? Have you tried to do this? Have you tried to do this? And that's very fascinating. And I think that's why he took some of the most simple and classic dish to the level that he took them, by always picking on them and challenging his team and his chef is how can we make it better? How can we reinvent it? So that's really fascinating.
It is an art, but as you say, it's also a business, a big business in your instance. How do you manage costs? And let me ask you about one specific cost, and that's the real estate. Because commercial real estate has really gone through quite a flux here, certainly in the United States, because of a lot of factors. How do you manage to control costs such as in commercial real estate?
So we have diversified quite a bit our business model, especially going through COVID. I think we've learned the hard way that because Daniel's old model was we all own and operated, like he owns this restaurant physically, the walls and everything else. There comes a lot of obligation to do this. I think what we've seen in commercial real estate is some of the biggest name player. I'm going to take like one like SL Green, for example, one of our partner, and they have those spectacular buildings like One Vanderbilt, One Madison. They're trying to get tenant in. They're trying to bring people back to work in the office. That's their whole business. They need to bring world-class amenities, and then they come to people like us and say, hey, what could we do here? We have this incredible space. And then we work with them, and then we develop some of the most incredible restaurants, like Le Pavillon at One Vanderbilt, which just celebrated 3 years. It's one of the most beautiful and grand restaurants in Midtown. We opened it out of the pandemic, and it's been a home run since we opened it. We were also looking at what the trends are, so we developed a menu more centric on vegetable and seafood, and it's been a home run. But yeah, to come back to the commercial real estate, I think a company like SL Green or larger commercial real estate company, they need world-class amenity, and then this is when they come to us. So it's been a win-win for them and for us.
Did you bring people back to the office at Pavillon?
Well, I think it's a very busy building, One Vanderbilt. So I think, it definitely helped getting people back to the office. And then even to take it another notch is, we're developing a new catering company like currently, which we're going to be announcing in the next few days. And we do want to provide great catering, food service for office building. And I think the focus is really to get people back to the office at every level. I was on call, going through a lot of RFPs with bank, financial institution, and all of that. Their food program, I don't think has ever been as important as it is today. They realize, I was talking to someone yesterday, she was telling me, now we're giving free food to our employees, which in the past they used to pay for, because we really want them to come, and food is a big factor to get people back in.
That was Sebastien Silvestri, who runs Daniel Boulud's restaurant group, Dinex. David Weston joins us now on the eve of the launch of your new program. I'm so excited to see you've been working on this for months. Well, maybe for a year now, and tonight it'll finally launch. What are we expecting?
Well, mainly we want to know what people's reaction is. I mean, the idea of this whole thing is it's going to air first 6 o'clock on Friday night, but then it'll be available through the weekend, both on Bloomberg, but also streaming and in different services. So the question is, do you want to sit down over the weekend and really take a look at these sorts of stories, like restaurants? I personally found it fascinating. We did talk to Daniel Boulud as well, that he's in the piece talking about Daniel, and that's where that was shot in Daniel. We all know Daniel Boulud in New York because of the high-end restaurants. I didn't understand he has a huge business. Dinex is a really huge business.
It's a dozen restaurants alone in New York City, and then also all across the country. At the end of the day, one thing that's beautiful about this new show is that it takes you to these gorgeous places and really interesting places across the country. Where have you been most excited to go so far?
Of course, I'm excited to go back to Detroit because I'm from Michigan, right? We've talked about that, so I got to go there. But listen, going to Allen, Texas, and looking at really what is in a data center was fascinating. It was 105 degrees, which was not perfect, but it was fascinating. We went to Kalamazoo, Michigan, and figured out how you handle pet care. So we've been, and Pittsburgh. We spent a fair amount of time in Pittsburgh, actually, with PNC Bank and what a regional bank really does and what its clients say about it. So we've gotten to go to quite a few good places. We're on our way to Mexico next, to Monterrey.
Forward to that, David.
I can't wait to see the show. I'm really excited about this because I think it's going to be different than anything else we have on Bloomberg. And it's going to be one of those shows that becomes a staple. I don't want to say like 60 Minutes, or like the old Wall Street, but I think there's some comparisons that are fair.
But to the 60 Minutes point, we really want to enlist all of you, everybody within Bloomberg. This is not just me. I mean, I'm starting out, but I would love anybody with great ideas for stories to tell. They otherwise don't have a place to tell them. We want to really open this up the way 60 Minutes has various correspondents doing stories.
David, we thank you so very much. Congratulations on the new show. More on the new Wall Street Week tonight at 6 p.m. New York time. Do not miss it. It's the start of a new era. This is Bloomberg. Fintech startup Intelligent Alpha just launched a chatbot-powered ETF that aims to mimic the investment mindset of Warren Buffett, Stanley Druckenmiller, David Tepper, and more. These are some of the greatest investors and traders of our time. We're going to discuss it with Bloomberg's Isabel Lee. And the question is, okay, if we're going to take the information from some of these great traders who have tended to move fast and nimbly, how does he do it? I mean, we talked to one of the founders here at Bloomberg Television. He hasn't even talked to any of these guys.
So as always, the answer is AI. So they're going to use a trio of these AI, ChatGPT, Claude, and Gemini, and they're going to harness the thinking and the investment personalities of these Wall Street luminaries and use that as their investment positions. But it's important to note that just because they chose this, it doesn't reflect real-life bets, basically. But it's really interesting because AI has quite not been proven yet in the ETF space.
That's interesting that you say that. I saw AI Reid Hoffman interviewing real-life Reid Hoffman, and I thought AI Reid Hoffman did a very good job, and the way they did it was just, I mean, Reid didn't have direct input into his AI counterpart. They just used things that were publicly accessible, available on the internet, clips of him. And I feel like it would be not terribly difficult. You know, we've seen other people, the Smeeds, for example, you know, Cole Smead, he has kind of replicated what Warren Buffett does in his own fund. I don't know why an AI Warren Buffett couldn't do it too.
And that's what sets them apart, they said. Instead of using just machine learning, they're using LLM, which is large language models. But we don't know. Out of the 16 AI-powered ETFs that Bloomberg Intelligence tracks, only one has outperformed the market. So for now, it's really in the early stages. We don't know yet what's going to happen. I mean, AI Reid Hoffman sounds better, but those aren't investment decisions.
That's
so
true.
It still remains to be seen, but it's definitely exciting because the space is so saturated, and this stands out. It's one of those buzzy ones.
I would debate with you if we had the time to all day about this.
I would definitely send
so
my AI to debate with you.
I'm feisty, I know. Bloomberg's Isabel Lee, we thank you so very much for your time. Tune in to ETF IQ every Monday at 12 p.m. Eastern. We have more information there for you on everything in the ETF universe. I want to also bring you some headlines here that caught our eye. Jamie Dimon is speaking at the Atlanta conference, and he says he hopes we have a soft landing, is skeptical about inflation. We spoke to him a little earlier this week as well on the sidelines of a Georgetown event. He also had that kind of skeptical on inflation tone there. Importantly, he also says that Trump's views may create more uncertainty in the world. Remember, Jamie Dimon hasn't really come out endorsing anyone in either way, but I think one thing that's interesting in reading the Jamie Dimon tea leaves this time around, Matthew, is you did see him come out with an op-ed in the Washington Post, I believe, about how he believes that Republicans should be part of a presidential cabinet of Democrats and vice versa.
Yep.
Where else did we hear that? It was Kamala Harris that said that after.
Yeah, for sure. I also think, though, that part of Trump's strategy is creating uncertainty. Like, that's what he wants to do, and he feels like that yields him some good examples. In any case, we'll continue to follow Jamie's comments at the Atlanta conference. Coming up is Bloomberg Tech.